I'm here to discuss the Fed and the policy shifts that may lie ahead with Matt Egan and John Levy. Matt is an executive vice president and co-head of Loomis Sayles' full discretion fixed income strategy, and John is a senior sovereign analyst in our macro strategies group, who also spent 10 years working at the Fed. Coming out of the pandemic, investors are focused on when and how the Fed will normalize monetary policy. John, are you worried about another taper tantrum, or do you think that they learned the lessons from 2013?
I think they certainly learned a lesson about the importance of communication, giving the market a lot of lead time, trying to telegraph how the policy adjustment is going to take place. That said, it is a huge policy adjustment. When they do start to wind down the asset purchases, there's going to be a real shift in the market, and there's going to be effectively a repricing. The Fed can try to adapt communications as much as possible, but this is a new regime, a change in the policy stance, so they are going to expect some adjustment, and I think that is a normal response.
I agree with you, John. Fed communication is critically important to manage expectations. We know that QE is effective at reducing real yields. Tapering quantitative easing has the opposite effect. It tends to drive real yields higher. It really comes down to supply and demand. Less Fed buying of treasuries means more have to clear the market, and the clearing mechanism is the yield and more importantly, the real yield. I think there's also a liquidity angle here. Tapering we view as a first step at reducing monetary accommodation, with policy rates following later on. So in that sense, we are really past the peak liquidity that was provided during the crisis. And markets, we all know, live on liquidity, so a tapering Fed will probably usher in more market volatility in the months ahead. And I think we got a taste of that after the Fed shifted its stance, even ever so modestly, at the last meeting.
So with the Fed's new average inflation targeting framework, a lot of people are worried about the consequences if they move too slowly. What if the economy is way too hot before the Fed begins to tighten? Matt, what are your thoughts on that?
Well, AIT does represent a really huge shift in terms of the Fed's reaction function to inflation. Previously, they responded preemptively ahead of the expected increase in inflation. Now they were signaling that they prefer to wait until inflation shows up. So it's a big change. There are really risks to both of those policies when you think about it. The problem with preemptive strikes is that inflation has become too tame. They were too successful in a way, and inflation has been anchored stubbornly below their 2% target, at least over the last decade or so. The risk of AIT is inflation becomes unrooted to the upside. In my opinion, I think the Fed would rather err to the side of an overshoot, because rightly or wrongly, they feel they can deal with higher than desired inflation. And I think the risk of tightening prematurely is less palatable to them from both an economic and political perspective. What do you think, John?
Yeah, I agree, Matt. I think that's right. I think there's a confidence that the tools are always there to tighten. The trick is going to be, how do you project the kind of credibility and communications to let the market know that you have confidence to do that? And we're trying out a whole new framework, and we're trying it amidst a completely unprecedented shock. So there's going to be a real onus on the Fed to tell the market what's happening in terms of inflation, how it understands that, and how and when it's going to take a response, and how that's consistent with its new framework. I think where we are now, the Fed really thinks there's sort of a burden of proof on the data to tell them that the recovery is well entrenched and that they can start to move. But I think there's no question that they're going to face challenges along the way. I mean, just thinking about some of the tools that they used after the last crisis, like the dot plot, maybe areas where they have to adjust how they use that tool and how they sort of signal to the market when and how they'll move in response to inflation once you move out of the initial phase where it can all be ascribed to reopening.
So Matt, as a fixed income investor, how are you thinking about expressing these themes?
Yeah, so inflation and yield curve risks are probably the most elevated that I've seen in my career. And they're really coming at a time when traditional benchmarks that a lot of fixed income managers are benched against, fixed income portfolios are benched against, have record long durations and ultra low yields. And so when you take a big step back over the past 30 years, the main risk for fixed income investors has been reinvestment rate risk. The good news is that this may be over. In other words, investing your coupon and principal at lower and lower and lower yields. The challenge we face is how do we preserve principal to get to that higher level of yield? And I think it really begs for an active management style. For one, managing duration simply, maintaining the flexibility to really significantly underweight duration, at least to those traditional indices, makes a lot of sense to me at times. And also the ability to diversify away from securities that have as a dominant risk factor changes or shifts in U.S. Treasury rates underpinning them. And this means going into spread sectors and other types of risk premiums, and that requires a certain skill set in navigating these other types of riskier assets.
In thinking about the future of Fed policy, as we think about future shocks, John, how could you see the Fed's reaction changing the next time there's a crisis?
I think the Fed has learned an enormous amount about the importance of incorporating a broad range of measures. They were, in a sense, very lucky that they still had some of the 2008 vintage tools that could be used in the early phases of this crisis. So I think the breadth of pieces of the response that they use, I think they're certainly going to remember that it's very important to act very quickly, particularly when there's any risk to market stability or system stability. And I think they're going to understand that there's a vital fiscal component. We've seen numerous cases throughout this crisis where the Fed has really made vocal the importance of a fiscal response. A number of the new tools that were created in response to the COVID crisis involve both the Fed and the Treasury or other fiscal authorities. So I think that is going to remain a very important part of their considerations going forward. Of course, it will depend on the nature of the shock, but I think those lessons are going to be long lasting.
Right. Even now, it does, to me at least, seem to be a tacit agreement between the Fed and the administration. And I look at Bidenomics, for example, and it's really raising the profile of the government's involvement in the economy, clearly aiming to pump up growth, get away from this sort of stagnation that we've seen in the economy, and address some major issues like wage inequality and so on. And I think the Fed can be there to help grease the wheels in a way by keeping the government's borrowing costs low. And we've seen this in the past during past crises, like wars even. And one could argue that the recent crisis that our country have faced, for example, with the pandemic, would require a call for greater coordination. However, I would say that this kind of relationship can only go so far if it does indeed exist. The Fed has to maintain its independence, and its mandate, its dual mandate, is very clear.
John, anything else you want to add?
I would just emphasize that you have an incredibly important new framework coming into place. This is really sort of untested, and it's being tested with an untested shock. The Fed did not plan for and come up with this framework with COVID in mind. But that said, they are going to utilize it. And I think there's going to be an enormous amount of focus, both within the institution and within the market, on how this thing works and how it's communicated. I think the Fed's well aware of that. It's not to say that there aren't going to be sort of fits and starts as we go forward. In a sense, the Fed is going to be learning by doing, and we're going to be learning by doing how to understand the Fed's reaction function, both as we continue to come out of the COVID shock, but also as we get into future challenges and the Fed continues to operate under a very different framework than it has in the past.
Right. Well, thank you very much, both of you, for those comments.